You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome back to Real Investor Radio. I'm Craig Fuhr, joined as always by Jack Bevere. Jack, what's going on today, man? How are you?
I'm doing great, man. Good morning. Good to see you.
We got an early one here today, Jack.
Yep.
Yes, we do. So don't know what time you all are listening to this one, but it's 9 o'clock Eastern right now. And Jack, I'm full of coffee. Got the Zins ready to go. Don't tell my wife, but anyway, we're rocking today. And wanted to start off with a couple of stories. One is just fun, Jack, and then the second one pertains directly to what we do for a living here at Dominion Financial. So I was I've been taking a deep dive lately, Jack, into AI and how it can help so many people, but I've been looking at it specifically for marketing promotion and for organization. We speak with sometimes hundreds of investors a day here in the office. And Jack, I got to be honest, I'm old. And so I don't always remember every person that I spoke with, but I take meticulous notes, and usually it's on, a legal pad with paper and pen. But I've been looking into AI and how we can use that to call through all the notes essentially, and then basically, search those notes for the person who I want to speak with that aligns with the criteria that I'm looking for. And it's been very interesting. Can't say I've mastered it yet, but just on the AI note front, Jack, here's a fun one for you. The Olympics are coming up this summer.
Yep.
Yes.
My wife's a swimmer, and so we've been following all the trials closely.
Yes. And anyway, I won't digress, but Al Michaels, the beloved Al Michaels, Jack, one of the great announcers, one of the great voices of all time. He's not getting any younger. In fact, I think he's about 107 right now, because he's been around since Howard Cosell days on Monday Night Football. But still, one of the great voices of all time. If you don't know who Al Michaels is, you're living under a rock. But so anyway, Jack, the story's quick. It says, not long ago, it would have seemed like a miracle, but this sort of announcement is becoming commonplace. Peacock, owned by NBC, will offer a personalized daily recaps of the Paris Olympics narrated by the voice of Al Michaels. However, that voice will be completely generated by artificial intelligence. The legendary sports announcer gave his blessing to the endeavor, marveling at the AI version of him, saying that it was perfect. So, I just think that it's an interesting time that we live in. I think that we're going to not only, 3 years from now, if you can imagine what we're doing today with AI, what will Al Michaels look like 3 years from now? Not just his generated voice, but his entire persona generated by AI. So, yeah, Jack, weigh in there. What are your thoughts?
That's super cool. I love that idea. That sounds really fun. We could, what we'll eventually do is we'll just get AI generated versions of ourselves. We'll just do like whatever the real estate news roundup is of that week, feed it in there, and have it just like do this podcast for us, right?
No need to wake up at 7 o'clock, Jack. You can just show up as your AI self.
Yep.
And somehow we'll pack all of your brain into AI, and perfect.
Like a little bit of a tangent on that. So
yeah.
Like I've been trying to figure out how to use AI in business, right? So like it's a very popular topic. Everyone's talking about it, and if you're raising capital right now, it's amazing. All the syndicators somehow figured out how to use AI overnight because that was the buzzword they needed to raise money, right?
Mm-hmm.
So, but like the real practical applications, I think they're not like as obvious to me yet. The customer service thing seems like the lowest hanging fruit, and like an AI bot to ask people about guidelines or like, ask questions about the process or whatever. Like, sure, that makes kind of sense to me, but it doesn't but that's like nowhere near like the productivity gains that everyone is expecting out of this technology. Right. And the thing is, like, one of the things I always struggled with, even coming out of college, was, all right, great, I got all this book knowledge, but like, how do I make money with that, right? And no one's publishing, like people who are like at the top of their game from a business point of view, they're not publishing, like you can't read what they're doing in a book to make money, right? Like the whole point of capitalism is like staying on the bleeding edge of like innovation and figuring out what's going on, or figuring out what the wrinkles are in the economy or where there's an imbalance in the economy to take advantage of that. Like that's not stuff that's published, and the journalists are the last ones to know, right? Like by the time you read an idea in the Wall Street Journal, all the money's been already made, right, on that idea. And so the idea, so I kind of struggle with it, that AI is going to like replace the entrepreneurial mindset. I feel like that's the thing it's not going to replace, because it's always looking backwards as to what's already happened and what's published and just aggregating that. But by the time AI figures it out, it's old news, right?
So are you saying that like
point of view.
if we took all of the book knowledge that you gained and loaded those books, that incredible wealth of knowledge into some sort of, chat bot, we couldn't get, you don't think that we're close to having sort of a predictive nature of AI that it can take all of that knowledge and then sort of predict, based on where we are today, where we would be tomorrow or the next?
Maybe. I mean, I'm sure that there are some applications in that regard if stuff gets like way out of whack, but a lot of like, I don't know, the stuff that we find is like finding a theory that there's some disequilibrium, right? Like just like that's kind of like the fundamental thing, right? There's some disequilibrium in some real estate market,
right?
Either the actual real estate market or the financing market, and then we look for one of the sides that we think is being underserved, and then we inject ourselves, right, and try to go serve that underserved market, and with the theory being that we can get paid well for serving that market because it's being underserved right now, right? Like that's kind of like the thesis, or that's kind of like the fundamental idea behind pretty much every little pivot we've done over the years. And so like maybe it could get to the point where it's recognizing that, though I don't know, like I have a hard time even explaining it to the point where I think I could then code it into something. But then it's picking up the phone, right? It's like setting up operations, picking up the phone and getting those customers and figuring out what their pain point is, and then setting up an operation that's going to serve them, right? And you get in front of 20 of those people, and you're like, hey, 6 of them told me the same thing. You know what? And then I build that operation, right? That's the thing I go set up. And I'm just not sure that AI is going to be able to inject itself like that to come up with like the novel business idea. I feel like there's always going to room like I don't think you can program hustle. You know what I mean?
No. I would say that just on the rabbit holes that I've gone down, what I find fascinating is call center technology. Obviously, if you've got the capital to really leverage AI, I think people are using it in interesting ways. But I think by and large, it's being used for the mundane right now. Like ChatGPT, please rewrite this for me. But what I find, I'll just finish with this. What I find interesting now is that you can program the GPT to be an NLP, Harvard-trained NLP expert, or you are this. You are a neurosurgeon trained for 25 years. Bring in all of that knowledge and answer this question for me, which has produced some pretty crazy results for me over the last few weeks of just trying it out. And so I'm anxious to see where it goes. Can't wait to hear Al Michaels' AI in Paris. That should be interesting. Maybe I'll throw a Paris accent on him as well. Second story that I thought was interesting, Jack, is that Jack, over the last couple of weeks, I would say over the last week, actually, I've probably quoted, I would say at least a half a dozen now, Jack, DSCR loans, 30-year fixed loans for our customers in the sixes. Now, am I at 75% LTV on that quote? Probably not, but 70, yeah, with good credit. Jack, I quoted one yesterday at 6 3/4. Day before 6 5/8. I just couldn't believe it. And so the 5-year is on a absolute roller coaster right now with downward pressure. And just yesterday, the U.S. Treasury sold $70 billion in 5-year notes, because that appears to be the 2 and the 5 appear to be the where everybody's flocking to right now, Jack, for short-term gains. And they sold at around 4.31%. They were thinking they would get 4.335. They wound up getting 4.331. So interesting time for the 5 and 10 and 2, frankly.
Yeah, I was going to ask you this. So it's June 27th today as we're recording this, and it's well, as of yesterday, as of close of business yesterday, it was 4.32%. Yeah, that's great. I mean, it's God, I miss so much. Like even over the winter, it was down to 3.83%, and I just didn't realize how great of an opportunity that was. Like I missed that big, right? Like, and then it went up 90 basis points. God, that's a brutal ride. But yeah, good to see it back down to 4.3. When it broke 4, I remember 4 being like, oh man, if it gets above 4, it's really going to affect markets and the sky is going to start to fall. And like, it hasn't, right? It's made everything like marginally more difficult and put more stress on everybody. But like, now we're all excited about 4.3. So hopefully we get a continued decline. Fingers crossed.
It's an interesting time. I think if folks are thinking about refining right now or just terming out, taking out a loan at a higher rate. I was talking with a guy yesterday who's, he's got a 9.5% rate on a portfolio that, I think he's got basically the bank rate of 25-year with a 5-year AM or a 7-year call, something like 5-year call. And, when we were talking at 6 and 7/8, he's pretty damn excited. He was, sign me up now type of thing. So
I did a survey recently of banks locally here in the Baltimore metro area and credit unions. And the best I was able to pull out, this was well, granted, this was like 2 months ago. The best I was able to pull out was like 6.75 for a credit union rate. And I was pretty proud of that. The bank that I had been working at, they pushed me. They were like 7.25 for a 25-year AM, 10-year call, 5-year reset. And I thought that was like, well, and so the best I could find, a month and a half, 2 months ago was 6.75. And now that DSCR is back to that range, I'm like, all right, sweet. Cause what hasn't gone down? Deposit rates. Like deposits are still burning off. So like the bank's cost of capital is still elevated. So I just don't feel that banks are going to be pushing their cost of capital back down. And I think that just means that the DSCR market and other private lending markets are just continuing to steal market share from banks, especially as they've got now even increasing CRE pressure, credit commercial real estate pressure. And it feels like the regulators are really kind of tuned in now to those issues and putting more acute pressure on bank boards. So I mean, we're not really seeing any easing in the lending market. I'm excited to dig into that topic and a bunch of other stuff with our guest today, Neil Timmins. He's a really good friend. He's a member of the Real Investor Roundtable, which is the mastermind that we talk about, that we put on 3 times a year. We do it as a nonprofit. There's lots of masterminds out there. There's lots of great masterminds out there with lots of great people, and everyone's got their different approaches. And what we've tried to do with Real Investor Roundtable is we're there for the ideas, right? Like we run the mastermind because we want to get the best ideas in one room 3 times a year with people that we know who are operators, who are thinkers, who are trying to be on the bleeding edge of real estate investing. And so that's kind of what we're screening for, right? If you come in the room and you wave a check, but you don't contribute any intellect to the room, we're not that interested, right? It's frankly not worth our time. And so I was really excited when Neil came because he's immediately, clearly an incredibly intelligent guy, tons of real estate investing experience, very outspoken guy. And he's in a market that we're not in at all. And he does a lot of stuff that we don't do. So I've really enjoyed spending time with Neil in RIR, and was really psyched that he agreed to come on to the podcast. So Neil, very welcome, and thank you very much for joining us.
Thanks for all the kind words. I sincerely appreciate it, and I appreciate you guys extending the invite.
Neil, welcome to the show. It's great to have you. Thanks for
Thanks,
taking the
Craig.
time. Hey, man, I pulled down a bio for you, and I probably rewrote it, but I'm sure you probably could tell it better than I could. Why don't you give folks sort of how you started off in the business? I think, if I'm not mistaken, you were a banker for a bit, and then you jumped into real estate because your mom was doing better than you were as a banker. So,
Yeah,
man, bring us up to speed about your career.
I'll give you. I'll try to condense it. How about that?
We've got time, man. Do your thing.
20 years now. Yes, I was a banker. Graduated from University of Nebraska Omaha. I born and raised in Iowa. Went there, played football, drove by Warren Buffett's personal house every single day that I went to school there. It was 2 blocks from the university. It was kind of cool. And then came back here to Iowa. Went to work for a big bank for a couple of years on the retail side. And my mom, we were just talking one day, and she's going, "Hey, you boys," I'm the eldest of 4 sons. She goes, "Oh, you guys are out of the house," and I'm thinking about going back to work. I haven't worked in 20 years or so. I don't know what to do though. And I was like, I thought about it for just a couple of seconds. I was like, "Mom, you should be a realtor. You drug me to more open houses than I can recall on Sundays, and we never moved ever. And you like people." So it seems that tells you the extent of what I knew also of a realtor and what they did.
Right.
She's like, "All right, that sounds good. I'll go do that." So she went and did that. Fast forward a year, she makes twice what I'm making when I'm working at a bank. And I was like, "Well, you know what? If Mom can do that, I can do better." So I've got 3 brothers, so it's a highly competitive household. So that was my entry point. I literally just weeks later, I was like, "All right, I'm gonna go get licensed and go become a realtor."
Well, that turned out pretty well for you.
It fit like a glove. Rookie of the year, sold 37 homes in my first year. 4 or 5 years later, owned a Remax, became the #1 Remax broker in Iowa, and it was just I found home is ultimately what I did. Yeah, and then that morphed on. I was really practiced, and technically I'm still an agent today, but practiced for quite a while and made a couple dollars, and then it was like, all right, where do the dollars get deployed? So stumbled across a handful of fix and flips through 2010, 11, 12, 13, but not particularly heavy until about 16, 17, somewhere in that range. And started buying more fix and flips, started stacking rentals, just got a comfort level for what that was. And then started plugging in from an education standpoint to learn more, to put process procedures in place. So I've flipped 200 to 300 at this point, bought dozens and dozens and dozens of rentals. And then about 5, maybe 6 years ago at this point, bought my first commercial property, bought an industrial building, 17,000 square feet, and get a few months in, and I'm like, "Oh, these people never call me. This is like the easiest. This is so much easier than buying these rental houses." And so went on and bought, have owned since then just about every asset class that exists, from retail to self-storage and mobile home parks to medical office to regular office.
It appears that there is no asset class that you wouldn't be interested in if I guess the numbers worked.
If the numbers work and the geographic location, for me, I'm in Des Moines, Iowa. I know this place. I've been inside of 10,000 plus homes as an agent in this place. I understand this place. When we get outside of here, it's pretty limited in terms of what my knowledge is from an asset class standpoint and geography. We do buy out of state. Typically, it's limited to industrial or flex properties only, though.
Before we jump into your pivot to commercial, you mentioned that you obviously, I would think you got a pretty good education on single family as a realtor, but in terms of single family as an investor, how did you school yourself up? I mean, Jack says you're a pretty smart guy. I believe him, but how'd you school yourself up on sort of taking a crappy house and making it beautiful again? Did you have mentors, or did you just sort of trial and error on that thing?
Yeah, trial and error. Being in the real estate side of things, what I had a really good sense of is, what's the ARV? What's this worth when it's done? And then I had to go solve for, okay, well, how do we fix it? What's that going to cost? And then backing down the numbers to go, what can I pay for it?
Mm-hmm.
And so just got my feet wet, and you start building confidence. Plus, some of this is too, I made some money early on. So it wasn't like some of these people go out, see where this is their last dime. This is their first and last dime. So I was going, all right, well, let's go figure this out. And this doesn't need to be profitable on the first one. It should be, but it doesn't need to be. But I'm going to learn as we go here.
Sure.
And so just getting a comfort level for what that is, and then ultimately getting to a contract crew who's now done probably more than 150 for me, same crew, getting that dialed in to know when I walk into a home today and I line Adam out, what I think needs to be done. I'm like 90+% certain what it's going to cost without making the phone call.
Sure.
Yeah.
Yeah. There's a real comfort level when you can, after you've done 100 or so, and you can walk into a house and you've seen it now, 50, 60 times, right, say, this one's 45 grand, and your contractor actually believes you and, doesn't want to, they agree. So right. Yeah, that's generally the progression for those who are keeping track of the numbers as they go. Jump in, Jack.
Given the time frame that you were buying there, where were you sourcing deals at the time? Was it because you were a real estate agent and you're buying on the MLS, and there was just because of the timing in the market, there were still profitable deals on MLS there, or were you doing off market stuff or foreclosures?
I picked up a handful. I don't recall the exact number, but my first rental property that I bought, which I still own today, was on the MLS. I literally went to lunch with a guy I had hired at Remax years and years ago, and we're just having lunch, just catching up. And he goes, "Oh, by the way, I'm listing this thing coming out of probate. It's a piece of junk. It's not going to be good for flip, but it could make a good rental. It's in this location." And I was like, you know what? I'm kind of feel like I'm in the market for rental, and so get me in there. So I got in there before it went on the market. Next day it rolls on, so I bought it. And I bought I don't know, 3 or 4 like that I portfolioed, and then it was going as a result of plugging in some of the education that's out there. It was going, let's go direct to seller. And part of that is, what's my background? My background on the Realtor side is talking to people and making things happen, right? So if I was an engineer, I know a bunch of people who only buy from wholesalers, and it's probably perfect to them. And a lot of times it's because their personality lines up to deal with wholesalers, not to go out there and be dealing with a homeowner. Mm-hmm. And so that's what led me down that path. 90+%, probably 95%, or ultimately source direct to seller.
And then how did you figure out the real estate, like the construction estimating side of things? Did you just start with easier ones and get progressively harder over time? Or like, what's that learning curve look like in terms of the construction side of things?
No, dude, you just start with going, anything we can make money on, you just do. And then you figure out that there's a buy box that needs to get narrowed down. And so what I found out is that my guys are no good. Ultimately, at the end of the day, we got the buy box down to a spot where it's 23 days from the day we close to the day it goes back on the market, 23 days. If we could hit 30, anything past 30, my guys are like melt, like the Wicked Witch. I mean, they'd be like, every new week they'd show up to the site on Monday morning. They're like Eeyore strutting into the place, like so totally depressed. They just can't handle it because they don't see enough progression in the project to get them very excited.
I always tell people that the time from demo to drywall.
Oh yeah.
Right. From drywall to the getting your certificate of your CO, that can be twice as long. And there's one reason for it, because it's easy to see the progress when the hammers are swinging during demo and putting in the rough and rough mechanicals and then throwing up drywall. You show up and you're like, wow, we got a lot done. But when you're doing those little mundane trim jobs that have to be done in 50-year-old houses, and you spend 6 hours on, some stair base trim that just doesn't fit just right, and you show up the next day and you're like, what in the hell did I accomplish yesterday? And I think that's that source of frustration for most contractors at that stage, at that very critical stage of every flip.
Yeah, we had a couple of projects just go forever, like 4 or 5 months, very involved. 100.
I'm shocked that it's just a couple.
100 plus some odd $1,000 rehabs. It's because we get to the point I'm like, okay, this has to. I mean, I identified a problem. We can't do this again. It just doesn't
So
work.
as you're scaling the business, and you figured out the how to source the deals, how to babysit the contractors and make sure that their pricing is right. What were you using for capital in terms of your equity and debt at that point? Because it's a capital intense business when you're flipping.
Oh yes, no doubt about that. So what we did is all property acquisition got 100% financed by a local bank, and I funded all rehab dollars.
Huh?
Just churn them. All the interest is paid at the time of closing, 6-month bullets for everything. So in the event we ever lasted 6 months, I had to pay interest, which I think occurred about 3 times in 3 years. It's rare. They were moving faster than that.
How many how many properties are you buying at this time?
Not very many, and we can get into that. I think our goal this year was a half a dozen. So I think we're almost there actually. So we'll exceed that for the year.
Is that that's now?
It's now, yeah.
What about back in the day? This like before you pivoted to commercial?
60 to 70 a year.
60 to 70 a year. So you're keeping, and that's keeping that crew full time. What's your average rehab?
Average rehab 40, about 35 to 40.
Gotcha. It's like mostly new. Yeah, mostly newer stuff. You're not moving walls much, if ever.
Oh, correct. Yeah. So
that became the buy box.
That became the buy box. Yes. Yeah. I would say not newer in age because we got a lot of stock that's, we're still dealing with a lot, not like where you are, but still the 1950s, 1960s, 70s, somewhere in this kind of range. But yes, the intent is we don't want to move walls. I want to do essentially fixtures forward.
Yeah. I gotcha. And then, so as the market gets more competitive, and I mean, at least what we found is like, as the market got more competitive and we wanted to keep buying houses, well, we had to just lift heavier and heavier weights, right, in order to find margin, because the easier stuff just was getting bid up, and to where the point where the margins just went from good to non-existent. Is that what precipitated your pivot into doing commercial? Like, did it just because, hey, this isn't as easy anymore, let me go try something else that's worth the energy?
I'm going to answer 2 different ways. One, we noticed a much more challenging environment about 2 years ago. So I'm curious as to when you saw that, but that's when we noticed it here. Is that we just weren't getting the responses and the marketing pieces. There were a lot of people in the marketplace, every Tom, Dick, and Harry, trying to make a go, and the real estate was on a tear, right?
Yeah.
And so, I mean, it's just incredible. I remember one. Don't quote me on the year, but I think it may have been 2 years ago in May, where we had 3 properties go under contract pending that month. And I think total up, all 3 properties, we made like $51,000, $52,000 over our asking price on a total of 3 properties. I'm like, 50 grand against greater than what you budgeted. I'm like, it's wild. And so you're right. It got more challenging, and then I'm kind of old school and somewhat conservative. I want to know we're going to make money when we go into this thing. I'm not going to budget as if I'm the guy setting the new comp in the neighborhood. It's just, if it happens, great, but I can't budget for that, because I'm certain when the day comes, the market does churn, you're losing.
Yeah.
I don't want to be stuck with that bag.
Jack, I've been speaking with a few investors, specifically in Florida lately, where their houses are sitting, and when I ask them, what are you selling it at? And they'll say, 375. I'm looking at them, what's the address? And I just do a quick look on Zillow or Redfin or one of those, and I see, let comp 310, 315. And I'm thinking, why 350? Why 375? And they're saying, well, we did a real great rehab and the place looks amazing. And I'm like, yeah, that strategy worked 2.5 years ago. I don't know that strategy works today, especially with inventory up as high as it is in some counties around the U.S. right now, up over 40% year over year. So,
yeah, Altos has. Have you guys seen the Altos research? ALTOS. They're like affiliated with Housing Wire, I think.
Yes.
They've got some really good research on. They're monitoring what's all the MLS data on a literally week over week basis, and so I like watching their stuff in terms of it seems to be that seems to be like the more kind of like trending thing right now is inventory increasing it's led to increased days on market, obviously. But it hasn't. But Case-Shiller housing prices are still up 6% year over year, and there's like 3 markets where there's like negative housing prices year over year. Everything else is still up. So like, yeah, inventory is building up, but housing prices are still going up. And so, but it's, but the concern is, as we are exiting the spring selling season right now, like, does the summer, does interest rates continuing to come down bail our asses out, right? Of this like increasing household inventory that's happening right now because buyers start coming back off the sidelines? Or are we going to keep seeing inventory building up to the point where we actually do start to see material softening in prices? What are you seeing on those fronts, Neil, in your neck of the woods?
Exactly what you just said. We're seeing the same thing, is that housing prices continue to rise. Days on market does extend. So things take a little longer, but you're getting the same or more money than what you got a year ago. It's just not as rabid, and across the board, they're not, you're not into a multiple bid situation on average, right? But the average.
Jack has a theory. Sorry, Neil, go ahead. I apologize.
No, go ahead.
Jack has this theory that I tend to agree with. It like if it's grandmom's house and it hasn't been updated since 1977, and they're going out at sort of top of the market comp or just sort of average comp, those are the houses that tend to sit and sort of languish. But the nicely rehabbed houses where somebody's gone in and done a really nice job on it, super clean and priced right, those houses tend to still move fairly quickly. Are you seeing the same thing?
I think that's fair. Some of that is, and I've said this for years, home buyers are credit rich and cash poor on average. And so they'll pay up. They'll get a property that's all done. But even if you discount grandma's house, it takes a special buyer who's going to even want to go in, who even has the financial capability to go in and rehab that thing.
Sure. Yeah. And like 2 years ago, everyone was like, had more, much more money in their savings accounts than they do today. And so like, hey, we're going to buy this house and it needs 15 grand. All right, cool. We got 15 grand of projects. Well, we're both working from home anyway. So like, you know what? We'll go do that over the course of the next 18 months. Today, those savings aren't there anymore. So like the premium and incremental credit is really expensive right now. So like the premium that a home buyer is putting on their cash is much higher than it was even 18 months ago. Yeah, we're seeing that same thing. Also, like the kind of the crappy, like the less talented flipper, the people who either didn't do as good of a rehab because they don't know what the hell they're doing and they're just not construction rehab people, or that they are running out of cash and they started to cut corners. Those are sitting, and like so, like when we're seeing like flip properties that have like 90+ days on the market, it tends to be like the pictures look fine and they've got 50 showings, but they got no offers because when you walk through it, you can see like the joints aren't mitered and like they use the cheap carpet and like the Uba Tuba granite and they skimped. You can tell that they're a little cash strapped, and that stuff's sitting. And I think those guys are getting washed out right now. Like that's where we're seeing payment defaults and other lenders taking properties back, is that category of stuff, like properties at the courthouse steps that I'm like, it's a private lender on that. And then we go look at it and peek in the windows and we're like, yeah, it's a crappy DIY rehab.
It's we watch some of the rehabbers out. It's going to create a better environment for the rest of the investors, the professionals who know how to get things accomplished.
Yeah. On the other side.
Yeah.
So Neil, I've had the pleasure of speaking with investors all over the country. I've spoken at large gatherings and conferences. And the question that I would always inevitably ask, number one question, is, why did you get into this business? And all the hands would raise, almost every one of them. And I would say, what's the word you're thinking right now? And they would say freedom.
Freedom.
I wanted to get out of my JOB so I could get into real estate investing and really get that freedom that I was looking for. And I think that resonates with kind of where you were at some point with single family, not really getting the freedom that you were seeking. And so talk about that, man. I mean, you got into the business, did fairly well, scaled that business. And at that point, I think a lot of guys would aspire to where you were at that time. figured it all out, and I'm doing, I've done 300 plus flips. What kind of freedom did that look like for you?
Wait,
Yeah.
let me interject. Is that that was because that was a very leading question, right? Like, is your answer freedom? Because I'm gonna say, like, my answer wasn't freedom. My answer was I fell in love with the idea that two things. One, this seemed back in 2007. I'm thinking, like, this seems like a very inefficient market, and I just, it's a very inefficient market with relatively low or pretty low barriers to entry. And I was like, that sounds like a money making opportunity. And I just got excited for, like, the potential to be able to do deals where I'm getting overpaid given the risk that I'm taking. And I fell in love with the assets are big enough that you can make real money, but small enough where there's still inefficiency in the market. And if I learn how to do it, if I learn this skill, I could move anywhere in the country, hell, anywhere in the world, and I would have a certain set of skills that would allow me to put food on the table. So that's actually what I fell in love with. It was never for freedom. I was never looking for freedom. I was looking for dopamine hits, right? And that's what I found in resi real estate. So I'm going to just put this, another theory of as to why people get involved in real estate out there. But what was it for you? What was it for you?
You know what's funny is I recall when I worked for the bank, I was working on my broker's license, and I was working on through a series of tests. And one of the things was talking about market theories that relates to investments in the stock market world and the analysis thereof, and the fact that everything is perfectly efficient in the market. All the price that McDonald's trades for today, it's because of all known factors that exist today. Right, all the details. It's highly efficient, and so the fact they would go on to say that it's a function of where are you at on the risk matrix. Right, some things are riskier, some things are less risky, and if you want to make more money in the stock market, you must take more risk. That's the only way to make any more money. The exception to that was real estate. Real estate, because it's so highly fragmented, because information does not flow in a highly efficient fashion, that on a risk reward basis, it can be all over the board. I still recall, I didn't do anything with that information for years. It just burned into my mind just because I think about things today on a risk reward basis. But to answer the question, yes, Craig's asking the question. I'm the guy in the crowd going, freedom, 100%. Yes, so that is, Craig already knows me. He for sure it's my answer. Yes, freedom. And that means a lot of different things. But a lot of people get into real estate, become a realtor, become an investor. They don't want to work for anybody, right? Us entrepreneurs will work 80 hours for half the pay for ourselves versus 40 for somebody else, right? Freedom of time, I think, is the ultimate pinnacle in my mind. Freedom of money. There's no doubt about that. Yes, I wasn't quite as sophisticated as you, Jack, back in 2007 to give that enough consideration. But Jack, I do echo it.
I'll just share one of the most interesting things, and you and I had this discussion, I think it was back in like 2016 in your office. And I don't know how many houses Dominion Properties owned at the time. Certainly not as many as today, but it was, still quite a few. And I think my question to you was, how big? How big do you want it? And you said it's not about, as big as it can be. And I always got the sense, man. I mean, you still drive the same car, you still live in the same house. I think I don't know that it's ever been about the money for you. And correct me if I'm wrong. I always thought it was more about, like, yeah, man, we're building a platform and we're going to see how big we can get it, how efficient we can make it, how well we can operate it, and just keep going. Am I wrong?
No, yeah, that's right. That's right. I rock a 2012 white Toyota Prius.
Yeah, you do.
With a roof rack.
Yeah, you do.
That bottoms out every time I'm in it and we come out of the garage together. Every time.
His wife has to stay in the car with him because it's such a chick magnet.
That's true. That's true. Yeah. And but yeah, no, the for me, work is the creative outlet, right? Like I like these ideas, and and the businesses are the place where I get to go apply ideas and see if those ideas are good enough to make money, right? Like, and so like that ends up being like the measuring stick as to like, are your ideas good enough that they're, you know, that they're better enough that they're on the front edge of the curve of, you know, what's going on in the market, right? And since the world's always changing, like it's, you know, it's the perfect like petri dish, right? To just like, you know, to try ideas and see if they'll if they can be profitable. So that was always what it was for
You
me.
once said to me that you wanted the Dominion Group to be an idea factory.
Yeah. I like that idea. And I try
awesome.
to attract people who and I love our staff. Our staff is freaking awesome. Because they're all killers and they'd be killers anywhere they went, anywhere they did. And we try to create an environment where you want to come, you have an idea and you want to go put it into action. Walk in my office, pitch me on it, and be like, and say, hey, here's how much money I need to go see if this thing's gonna work, but I think it's gonna, and here's the reason why. And we'll go back and forth beating it up for a little bit, and then 20 minutes later, you walk out and you're putting that thing into action. And those people thrive at Dominion, and I got a bunch of them now, and they're awesome. And I think they're having fun, and we're having fun watching them, play. So anyway. Neil, let's get back to so what were you not satisfied with on the residential side? Because I've like played with the idea over the years of getting into other asset classes, and ultimately there's something in my personality that ends up recoiling, and I'm like, I'll just do more in resi or do different things in resi because I know enough about resi that I feel like it's safer for me to stay within resi even if I'm like doing different things there. And like, so like for me, like there's something in my personality that won't let me jump asset classes with nearly the fluidity that you have. Like, well, teach me. How did you do that? How did you make that pivot, and how have you continued to make that pivot?
First, why did you make that pivot?
Mm-hmm. Yeah, so the first one got put in front of me by a broker, and if you're flipping like I flipped, you got a tax problem sooner or later, right? Mm-hmm. And so the first property got put in front of me, and I just ran the risk reward. What's this going to cost me? What's the downside? And it's like, well, the tenant's in there, and if they leave, the building's worth about 25% more because they're in a lease that's not very attractive from the landlord standpoint. It was an okay cap rate, but given the financing terms at the time, the spread was just fine. So I was going, okay, well, this is a good enough deal, and I can depreciate it, cost seg it, and get that thing to go. And someday their lease, they got a long-term lease still. The day will come where they're out and the rent's going up sharply, and that building's worth, I don't know, 2 to 3x more.
What was the asset? Just curious.
17,000 square foot industrial building. The largest grocer in town operates their bakery out of it.
Oh, so it was like a known quantity tenant to you as well?
Oh yeah, high quality. Yeah.
The whole world of non-credit tenant leasing, like small commercial, small retail, strip centers, right? Like strip centers, like that's a whole freaking industry, and I just cannot seem to get my head around like the lack of credit profile of the tenants. I don't know. Hey, I do Section 8 tenants, so like look at me talking. But but at least there, the federal government is the one sending the vast majority of the wire. But owning a strip center in a recessionary environment just terrifies the shit out of me.
Well, the second commercial property I bought was 11,000 square feet of retail, so I bought a strip center.
Okay, how'd it go?
Subway was there. Dairy Queen was there, and a vet clinic who had put a lot of money into their place, and then like 4 or 5 mom and pops, like straight mom and pops. Like they're not businesses; they're people with jobs. That's the easiest way to describe it.
The nail salon, the barber shop.
You got it. Yep. Came through COVID with that. My intent there, terrific location, a transitioning area. A major developer had bought the 2 acres to one side of it, had leveled everything. And so I'm like, well, the day's coming where this whole area is going to get improved. So I brought a third-party property manager on there for that one. And this is block construction, like 1959 construction. And I told my property manager, I said, when duct tape won't do, get 2 rolls. I said, the day will come where this building gets leveled. So I don't want to hear about anything else. We're not talking about anything new. All you're going to do is fix anything that ever goes wrong in this place. Because all its highest and best use will be dirt at some point. Yeah.
That's hilarious.
Yeah. So I kept that property. We came through COVID with it. We sold it 3.5 years later. First, I bought it on some unique seller terms, which we can get into in a second. But anyway, I kept it 3.5 years and sold it for, I'm ballparking, just about double what I paid for it.
Was it, and it was on market? You sourced it on market?
This was off market through a broker.
How do you, through a broker. So
so building relationships with brokers in town, local people, yes, I'm an agent. So the first thing I lead with is I'm not interested in commission. I'm interested in you getting paid the commission. So I don't participate in commission at all. I'm looking to place dollars. I'm looking to acquire assets.
And you just kind of let them know what you're looking for, and you get the phone call.
Yeah, then follow up and follow up and follow up. I mean, it's
of course
when the deal's good, the first person they call is buying the deal, right?
Mm-hmm.
Yep.
So yeah, walk me through that. Like walk me through the mindset shift that I should make if I'm been doing residential, and like what's been burned into my brain is if it's for at least for the past 8 years is that if it's on market, it's not a deal, right? Like if it's on the MLS, there's no money in it.
Yeah.
And so like the name of the game for the past 7 years has been off market deals.
Yeah.
But the idea of sending postcards and getting some like multifamily owner, I've heard stories about it, right? Like I've heard that I've heard that it has happened, but then I've had a hard time seeing people who have been able to replicate that over and over and over again, right? They do one, then they get it, and then they don't do a deal for another like 2.5 years. And I'm like, well, I can't build a business around that.
I think that's fair. Yeah, we bought an 8-plex off a postcard. I bought a mobile home park off a postcard.
You're that guy. Okay, great. Yeah.
But they're so far. But you're right. They're so far in between. Before we said when we got online, I just do the unscalable. We just do these things and get them on occasion. I'm trying to think if we've ever bought any of these properties, if they've ever been listed. We bought one property that was listed. Everything else has been off market through a broker or direct to seller.
Off market or broker pre-market.
It's broker pre-market. That's what I mean. Broker pre-market. Yep.
So
that's been the bulk of them.
So do you do that? Like, so for commercial, would you say like, is this multifamily and anything industrial, retail, office where the game is, where you think the game is, or rather the game is that you like network with the brokers and stay in front of them so that they're the person that they think about when they get that magic call?
Yes, for us, it's. I love value add. Anything, just like a house, right? You love dented and scratched houses just like I do, and I want my commercial the same way because I'm not going to be the guy. In today's environment, you're going to go out and buy what a stabilized 7 cap, and then I got to go borrow at 7.
Right.
I'm not employing capital that way.
Right.
The risk reward matrix is so far out of whack on the average deal that I'll just sit in the sidelines and be patient because the day will come, the pendulum will swing. We'll go buy something else that makes sense. So yes, it's exactly like that. Just communicate. Here's what we're after. Here's what we're after. And then when we buy one, we just bought one. Here's what we just did.
Did you ever do any self-storage?
I have one self-storage. I bought with a partner. He leads the deal. I'm just the money on the deal. It's in Indiana. It's our worst asset in the whole portfolio. It isn't all rainbows, right? Yeah.
So have you how have you attacked the commercial side of things, or has it been just like, hey, we're going to like send a bunch of postcards and wait for the triple to call? Like, we're going to hit a triple when you buy that property to call? I mean, or like, is it like, did you get into industrial and then you got into strip centers and you were working that for a while? Or has it been like, hey, you'll buy a deal? And
it was a slow, just moving thing. I just, bought the first one and then the second one, like 8-9 months later. Then it was like, all right, this is easier. Who else can I talk to? Just building a few more relationships and stuff would trickle in. if I can build a couple of relationships and you can go buy one deal every 12 months, one deal every 18 months, great. And then that's kind of evolved. And so last year in the office, it was like, you know what, let's do more of this. Interest rate, the 5-year treasury doubled inside of a year. Well, it had never doubled in the history of the 5-year treasury in a year ever until it did. Right. So my thesis is that sooner or later, somebody's going to roll off their 5-year commercial mortgage that is a balloon, and they got a 3 or 4% rate, and they're going to roll back on at 7 or 8, and that there's going to be some breakage.
Yeah.
And so my intent was, let's focus on commercial. I see an opportunity coming down the pipeline that slightly resembles, the housing crisis when rates moved and all the cracking took place on the ARMs back in that 2008 era. So last year was let's focus heavily on commercial side. Let's flip some, but not very much, and let's start building a network of investors so that when the opportunity comes, we can actually take down the opportunity.
Neil, I think that's part of the conversation I'd love to jump into with you, as well as syndications that Jack mentioned before we press record. Do we have you for a second episode? Can you hang out for one more with us?
I would love it.
That's fantastic. Well, Jack, why don't we end this one here? Hope everybody's enjoyed speaking with Neil today, listening in. Please send us your comments, suggestions, questions. Love that. And we'll go ahead and end this episode and jump back in with Neil Timmins next. This is Real Investor Radio. We'll see you on the next one.